What's going on, everybody? It's Natasha Watkins, your favorite realtor. And guess who I have with me today, Mr. Karlin? It's been a while. The
I
man, the
know,
myth, the
man.
legend, the
I
greatest.
was feeling neglected, you know.
We don't want to talk about feeling neglected, man. I've been seeing your Instagram, so we're not even going to go there. But I saw like the craziest thing on Instagram, and I reached out to you because I wanted to verify this thing.
Credit cards at all, like zero credit cards? How do you rent a car? How do you build a credit? How do you live in a life that you can't even have a credit?
There's only one reason to build credit, and that's to borrow money. If you don't plan to borrow money, you don't need to build credit.
But what about like a mortgage?
Well, you can get a mortgage with manual underwriting with a zero credit score.
What is manual underwriting?
Manual underwriting is the way mortgages were done when I got in the real estate business in 1978. They actually look at the human being and say, do you have a job? They verify the job. What is your income? Let me verify the income with your employer. Verify your deposit, a VOD. And so we find out if you have the money for the down payment in the bank. They actually go through the documents and prove that the person is financially able to buy a house.
The manual underwriting thing, I just wanted to touch base with you because that was really interesting to me. If we can explain a little bit of how that process is going about, what it actually is, and who is it actually for?
Okay. So manual underwriting as opposed to what we call AUS, which is automated underwriting, automated underwriting system. So typically when we do, and this is really for what we call QM loans, or qualified mortgages, right?
Got it.
And when I say qualified, typically I'll tell people it's like a traditional loan, right? I sort of, traditional loans are loans that you're using tax returns, pay stubs, W-2s, 1099s to qualify, right? So in a traditional loan, we use something called mortgage companies, mortgage banks, called AUS system. So when we do a conventional loan or like an FHA loan, we'll put everything into the computer system. Most loan officers, lenders, and then we'll press a button, and that button will do an automated underwrite. Right? And that automated underwrite is with the guidelines of Fannie Mae, Freddie Mac, FHA, and then it will tell us whether the loan is approvable or not. Right? So, and that really, that AUS underwrite, and we call them DU. DU or LP. DU is for Fannie Mae, and LP is Freddie Mac's system underwrite. And it is I tell people it's the roadmap for underwriters to underwrite a loan, right? So if we as loan officers put the information, like loan officer assistants, processors, put the information into the computer system correctly. It's called a loan originating system, LOS. A loan originating system. We put our information in correctly, and we press a button, and the AUS runs, and it comes back with approve eligible. Then we, as long as we put the information in correctly, we're confident that the loan will get an approval by the underwriter.
Got it. Right? And this is like 99.9%, like in the 90s, confident that this loan will go through.
Right. And again, it's all about user input, right? User entry. So as a loan officer, I got to make sure that I put in the right assets. I put in the correct income. We run, typically, you have to run credit. And AUS, LP, or DU will only run with all those aspects, with income, with assets, with credit. You have to have credit scores for it to run. A manual underwrite is you're not using the system, right? You're not using the AUS. Some underwriter is manually underwriting the information. Why? Because it's not going to pass through AUS. Right? AUS must see credit to give a pass, approve eligible. Make sense?
Yeah, 100%.
So in a manual underwrite, when when Dave Ramsey says yes, you can get a loan without credit, that is true. And by the way, you're more apt to getting a loan with no credit than you are with bad credit. Bad credit is worse than no credit.
Oh wow, I
Yeah,
didn't. I didn't
interestingly
realize
enough. Well, because bad credit, think about this, right? Bad credit is really communicating or showing for whatever reason, right? There could be many reasons, right? So I've had some borrowers that have bad credit, and it's because they've had identity theft, right? So you have to, I always ask borrowers when I look at the credit, what happened? Tell me the story, right?
Okay.
And if someone's got a whole bunch of collections and a whole bunch of charge-offs and a bankruptcy, and they're not really someone that it's going to be tough.
Exactly.
Right?
It shows your
how would
history.
you feel giving $500,000 to someone?
$500,000. What's the $500,000?
Forget about $500,000. I mean, how about 10,000?
Yeah.
So credit is really important. Credit is really important. Can you get a loan without credit? As Dave Ramsey says, yes, you can. Yes, you can. Through what? Through a manual underwriting. Right?
Got it.
Not all lenders do it, and not all loan programs. It's typically like an FHA loan, FHA specifically, Federal Housing Administration. You can get a loan with no credit with alternate trade lines.
Okay.
So
Can you explain what an alternate trade line is?
So an alternate trade line is like paying your rent to your landlord.
Got it.
Or your utility bill, or a phone bill, or a water bill, or a utility electric, or cable, something like that, where you show the lender a track record. Typically, they want to see at least 12 months, 12 to 24. But you show a track record that you have been responsible with your bills, right? And yes, there are a lot. There are people that that don't have credit. Either because they're young or and
maybe
new
just
to the
even new
credit
to the
game.
country as well.
New to the country, or people sometimes just don't want to use credit cards.
Yeah.
And that's understandable, right? Or people who. Yeah, they just don't have credit.
Yeah.
So, and it is easy, by the way, to build credit pretty quickly.
Okay.
My wife came from another country. My wife came from Brazil.
Yeah.
And within 60 days, we had credit scores for her from all three bureaus.
Got it.
So
did you use like an authorized user? How do
Exactly. So there's authorized user, and for those who don't know about authorized user, it's a great way to get you're basically lending like I would lend you my credit line.
Yeah.
I would lend you my credit line that I've had for 5, 10, 20 years, and by lending you my credit line that goes on your credit report, you have scores. I mean that gives you strength in your credit history.
Yeah. But you also want to make sure this person has a good history, because if they have weaknesses,
you only do that with someone who's got a good history and is not carrying a big balance as well.
Yeah.
And we also have credit builder loans and credit builder credit cards. So there's something called a secure. And I did this for my wife. It's a secured credit card.
Okay.
Where you're basically putting down a certain amount of money, let's say $500.
Yeah.
And you're putting that down as like a security deposit.
Got it.
Right. And it's a security deposit where now you have a $500 credit card, and you go. Just like a regular credit card, the bank's holding your $500.
Yeah.
And for the use of this card, but it allows you to go buy your coffee, buy stuff, buy furniture, buy whatever you want on the card.
Yeah.
Right? And you use it, you pay it, you use it, you pay it, and they're holding a security deposit. And then once your credit builds up, close out the account, get your money back, and go get a regular credit card.
Got it. Does that closing out, like I always heard like closing out an account is bad. Is that particular one bad, or?
That's interesting. So it depends. It depends. If you've had a long-term account, and it's got a zero balance and it's one of your few cards, keep it. I mean, this is my opinion. Keep it, because it does help. A longer-term account that is in good standing, even though you're not using it, is helpful to a credit score.
Yeah.
So, closing out all your accounts will bring down, yes, it will bring down your credit score, because now you don't have anything. And it's also good to use credit once in a while, right?
Got it.
$10, buy a coffee, buy this, buy that, to show that you're using it and you're paying it. You're using it and you're paying it.
Yeah. So let's get back. We drifted off a little bit. Let's get back to the manual underwriting a little. So like, who would we mentioned somebody that's new into the country? Who else would you suggest this loan for? And what does that process kind of look like for the buyer if they're looking to buy a house?
Well, you know, they have to have a good income, or I don't want to say good income, but what as you know, what we look at, one of the most important things in underwriting is debt to income ratio.
Yes,
right.
DTI.
So we want to look DTI. So we want to look at what you're buying and your monthly debt obligations are in comparison to your income.
Yeah.
Right. So we want to make sure that the DTI is good for the loan that you're going for. We want to make sure that your income history, your employment history, is good. And typically, typically most lenders are looking for at least 2 years of a solid income history, and then that you have the money for the down payment. Right. Those are the important things. And then of course the credit. But if it's non-traditional credit, again, alternate trade lines, then you want to have typically you want to have 3 trade lines of at least 12 months.
So even with the manual underwriting, you still have to have the trade lines?
Yeah, you cannot have, I don't think, I could be wrong, but I don't think I am, there's any lender that if you have 0, if it's a primary purchase, and you are, you're in the United States, right? I'm not talking about a foreign national loan.
Yeah.
You're in the United States, and you have to show some kind of payment history.
Okay.
To my knowledge, to the best of my knowledge.
Got
right?
it. Got it.
Because if you don't show and just think about this sort of logically, right? If you're not showing a payment history of some kind, how does someone who's going to give you money have any confidence to know if you have no rent history, you haven't paid a landlord, no utility history, no cell phone history, it's like, how do I know you're going to make your payments of a mortgage?
100%.
Right?
100%.
Yeah.
So what's important is just some sort of history of you actually paying something.
Correct.
Got it.
Correct.
So I know we've done in the past like no income check loans.
Yeah.
Can you explain a little bit about that? And like, let's compare it to kind of like the manual underwriting, like who would you suggest each for? Because with the no income check loans, like you're not looking at the credit score as well, or am I incorrect on that one?
So there's really no income check loans. Okay, so I was going to say there's really no such thing as a no income check loan.
Okay.
It's really, there are things in lieu of income.
Got
right?
it.
So when I say that, I say, so we have loans that are what we call bank statement loan, right? For people who are self-employed and they don't show much on their tax return, but they have great bank business deposits.
Got it.
So they take the business deposits over a 12 or 24 month period, and they average those deposits and they multiply them by an expense factor, and then they give you what your income would be based on the bank
business
deposits.
Yeah.
Right? Then we also have a loan which is like a 1099 loan, where you could take 90% of somebody's 1099, right? Still income, right? Still an income check. And then there's a P&L loan where you show it's a profit and loss, right? Profit and loss for 12 or 24 months from an accountant or an enrolled agent of the IRS, and that person, that accountant or enrolled agent of the IRS, puts together a P&L for that borrower's business, and that is what we take in lieu of income.
Got it.
Then we also have an investment loan, which is called DSCR, debt servicing.
Okay.
It's a debt servicing loan where in fact, we're working on one right now. Where the rental income, the market or proposed rental income from the property is equal to, or could be a little less than, a little less than the monthly mortgage payment, right?
Got it.
Has to be an investment property, and their rental income has to approximately cover the mortgage payment. Could be a little less.
Yeah. So what's the drawbacks with these? Because these all seem so like appealing. Like, why do most people not tend to go this way?
Well, I wouldn't say that most people don't go this way. It's all dependent upon the person's scenario.
Got it.
Right? What a good loan officer does, you have to listen to your client. Like,
Be a detective.
what money do they have, and what, excuse me, have they shown enough income on their tax returns, right? Are they buying an investment property? They're buying by the way, there are other non-QM. By the way, those loans that I mentioned before are what we call non-QM.
Okay.
Remember when I said QM at the beginning?
Yeah.
Which is like traditional.
Yeah.
Those are like non-QM.
Yes.
And there's a number of more that I did not mention. But
Got it. But you have options, so we're just trying to identify your scenario and figure out exactly what works best for you. Definitely.
Now, the thing is, on most non-QM loans, in fact, I don't even know one. Maybe a foreign national. National.
Can you
loan.
explain that one a little bit? Because I was going to ask you, what is a foreign national?
So a foreign national is someone who does not live in the United States, but wants to buy property in the United States, right?
Okay.
Or they're they're buying. A foreign national is someone who's buying an investment property in the United States.
Okay.
And in that case, obviously, if they're foreign national, they don't have United States credit.
Yeah.
Right. They may have credit in another country.
Yeah.
And if they do, we would take a look at that. But
Okay.
sometimes they don't. And so if they don't, we would go with, again, like alternate trade lines, as I mentioned before.
Oh, okay. So if they have credit somewhere else, we can take that into actual consideration.
There are many lenders that will look at that and take that into consideration. Yes.
Got it.
Yes,
Is the process any different than doing a traditional loan in terms of like time frame, in terms of like interest rate? Is the interest rate a little bit higher on those?
So on almost all non-QM loans, because they're not traditional, you are going to say, and you asked me before, like, why wouldn't people like do that? Why wouldn't people do those non-QM loans? Because typically they come with higher interest rates. Yes, they do.
Got it.
Right? Just think about this again. Non-traditional, right? If you're doing traditional, which is, conventional, FHA, Fannie Mae, Freddie Mac, you're getting a better interest rate.
Got it.
Right.
Does this have to do with a little bit of maybe like the risk? Like it seems a little bit more risky for the bank to do those particular loans?
That's exactly right. It has to do. That's exactly right. It has to do with more of a riskier. It's more of a riskier. It's interesting. I believe that is accurate because a lot of these loans, I say, like the non-QM loans, perhaps are a little risky, but it's not even that they're risky. I take that back. It's sort of like off the beaten path. You know what I mean? Because here's the thing, and if you're looking at someone, I have clients who have bank statements that they're depositing $50,000, $100,000 a month.
Yeah.
Are they more risky than the person who's putting down and they're putting down 20%?
Got it.
But you have an FHA loan who's putting down 3.5%, and they make
I take the 20% every day.
Well, that's the thing.
Is that part of the criteria though? Do they have to put down?
So a lot of the non-QM loans, I think I have a bank statement loan. I explained to you before the bank statement deposits. You can go as little as 10% down on that.
Okay.
But the interest rate is going to be considerably higher.
Got it.
So if you put down more money, it is, yes, less risk for the lender.
Got it.
And more benefit to you in that typically the interest rate's going to be better.
Bring down your payment as well.
Yes.
Yeah.
Correct.
Is that what you suggest? Is it for someone who has a large amount of cash? Is that where you typically would weigh, okay, this interest rate versus what this monthly payment is going to be, and kind of analyze which was going to give them a better number?
Give me that again. If someone has,
like, let's say that they do have credit, right?
Yeah.
And you look at it, and they're doing a large amount of cash. would that be a
A large
scenario
amount of cash. What do you mean for down payment?
for down payment? Yeah, would that be a scenario that you decide that this may be a better scenario for them to go to no income check loan? Is there any scenario that even if they do have the credit, that it makes more sense for them to go the other way?
No. I mean, my first thing is to see if I can take someone to a conventional loan, right? Because a conventional loan, conventional or FHA,
Okay.
and it's based on your down payment, it's based on your credit score, it's based on you know, your tax returns, or you have enough income to qualify, right? So, and why? Why is that the thought process? Well, because the borrower is going to get a better deal on that. You're going to get a better interest rate, and everybody wants the best interest rate, right?
Yeah.
There's two things that everybody wants, and I know this. I mean, it's just obvious. They want the best interest rate in town, and they want the lowest closing costs. Period.
But one thing that I've noticed being in this business for a while now is sometimes when the best interest rate is there, the competition is hella hard. Like there's a lot more competition because now a lot more people are able to qualify for any particular loan. Is that correct?
I'm not clear on what you're saying. So,
Like for instance, when the interest rates was at 3 and 4%,
yeah,
now a wider pool of people can qualify for those loans.
that is correct. That's
Yeah.
correct. Right.
Yeah.
And remember this, right? When rates are lower, more people. Number one, as just you said, they more people qualify. But number two, more people are coming out.
Yeah.
More people are coming out. Lower interest. I mean, that's why when COVID hit, and they lower the interest rates, right? Government keeps people spending. People borrow. Excuse me. People spending and borrowing, right?
Yeah.
Oh, interest rates are low. People are coming out. They're going to buy. They're going to refinance. It's a great time, and and the competition is much greater, of course. Yeah.
So we've seen a lot of change in over this last couple of months. You know, new presidents, everything like that. Where are you foreseeing the rates going now? I know I had to hit you with it. I know it's like manual underwriting, but look, people want to know.
Why not ask?
Do you think it's going to have a positive or a negative effect on the rates?
I gotta say, I have a feeling, and I know, Donald Trump is. I mean, he actually said at one point he's going to cause rates to come down. Did you hear that? I don't know if you heard that.
No, I did not hear that.
He said and it's sort of difficult. You cannot tell the Federal Reserve chairman, unless you fire the federal and everybody likes him.
Yeah.
He's got a favorable rating. You can't really tell the rates to go down. However, I have a feeling. I do. I have this feeling that, I mean, we all, in the mortgage industry and a lot of my peers, we are confident rates are coming down. But I think that Donald Trump will have a positive impact on bringing rates down. I don't know. I have that feeling that he's going to do that in the economy. That's going to happen. Yeah.
Got it. All right. Cool. I know I put you on the spot with that.
No,
one.
I'm good with that. You
worries,
always put
no.
me on the spot.
I try
may walk
not.
off
Well,
and
I
just say, "Gotta
intentionally
go."
try to do it. With everything that's going the way it is, like it's still early in the year. Like, how are we seeing the mortgage business? Are we seeing an uptick now? We're only 1 month into the year, and maybe this is unfair to ask right now. But how are we seeing? Are we seeing more clients come out, trying to attempt to buy in this economy?
So, I can't speak for. I'm pretty busy. People are calling. People are still buying, and refinancing. I have people. It's really interesting. Like I have clients right now who are taking money out of some of their current properties, whether it be primary or investment, to go buy another property.
Yeah.
Right? So I have a client right now who's actually going to be closing in the next couple of weeks. He just took out over $300,000 from his primary home, and he's putting 50% down on the purchase of an investment condominium.
Got it.
So, and this is going to be his, I think, his fourth property.
And how does that work? Like, how do you take that money out? Like, what's the
Well,
ways
it's
of...
equity. You know, equity, right?
Well, for the other people, I
right.
But
Thanks.
how
All
do they...
So it's real. I'll tell you something. It's truly extraordinary how many people I've seen do this, and you don't have to be a wealthy person to do this, right? You buy a property. You buy a property, and of course, the expectation is, and it doesn't always happen, but that property is going to appreciate in value, right? The value is going to go up, and over time, you're going to pay off your mortgage, right? So if you think of like a sort of like a graph here where the value is going up and your principal that you owe is going down, and this section in the middle is what we call equity. It's the difference between what you owe and what the value is. And when I say value, I mean the market value, right? So if you owe $200,000, but your property is worth $800,000, you have $600,000
to play with
of equity.
Yeah.
Now it's tied up in the home. So how do you get it?
Yeah.
Right? You want to get access
That's the question.
to that
That's
money.
$1 million question.
Right. So, well, there's one of two ways. You can, there's a HELOC, which is a home equity line of credit, where you can, it's a second lien on the home, where you're taking money out of the home. There's on a line, right? So it's not you're getting a line of credit, so you can use it and pull back. You can use it and put it back. Use it and put it back as you want for the first 10 years of the typically the draw periods for the first 10 years, some or less. Then there's a HE loan, where you're taking money as a second lien out of the home as a loan.